So, maybe from an industry's perspective, we know that an industry is a combination of so many firms. But we also see that, some firms are doing extremely well in an industry. Some firms might not be able to do well in an industry. So, from an industry's perspective, how will you analyze a firm's performance?
So, usually the measures are financial.
Okay.
So, though of course, inside the firm there are operating parameters, and sometimes people external to the firm may have access to these operating parameters because the firm discloses it.
Okay.
In its statements,
Okay.
financial statements.
Okay.
But many times they don't disclose it. So, all you have access to is their overall financial numbers.
Okay.
So, what revenue they have, how is the revenue changing, how is it growing?
Okay.
And for that revenue, what are the cost items? Some heads they will give you.
Yeah.
And then therefore profits. Different levels of profit. Profit at the gross margin level. We have to explain what is.
Yeah.
Then what is the profit at the EBITDA, that is earning before interest, depreciation, tax, amortization.
Yeah.
And then what is the net profit margin, which is
Okay.
after all these financial things, what is the net profit margin they're making?
Okay.
And how is this profit itself changing over a period of time?
Okay.
And how much of the assets, what kind of assets they have put to use to produce these revenues.
Okay.
So, how much capital did they raise?
Yeah.
Are they getting return for the capital? Because if I'm an investor, I invested in a company.
Yeah.
I need to know whether or not my investment, I could have put in some other company, maybe I've got
Yes.
better returns.
Yes.
So, I need to know the investment, what returns it is giving.
Okay.
So, I need to know that.
Okay.
And so, you have to explain, for example, something you have to explain. So, how did you raise money? So, you could have raised it using as capital through equity.
Yeah.
Giving shares basically in your company.
Yeah.
So, you could have raised money like that. Or you could have borrowed money from a bank. So, if you borrowed money, then have you borrowed too much money?
Yeah.
Because if you borrow too much money, you have to repay it.
Yeah.
So, do you have the capacity to repay this money?
Interest payments become very
high. So, that affects your profitability.
Yeah.
No, more than that also, the company might become bankrupt. I mean, it may not be able to repay the money to the bank. Then it becomes delinquent, right?
Yeah.
So, does it have the capacity to repay? Because revenues can go up and down.
Yeah.
Profit also can go up and
Yeah.
down. Then there is this business of how well it's managing its cash.
Okay.
So, is it keeping enough cash to take care of its operations, running operations?
Okay.
And how is it generating cash?
Okay.
So, it can generate. So, for example, a company may be doing a lot of revenues it may be producing, but when it bills its customers, it may not be able to collect the money.
Oh, yes.
So, for example, government contracts, government doesn't pay in time.
There will be delay in getting
a lot of delay.
Yeah.
So, in that case, that period of time when the work is done, but they're not able to collect the money.
Yeah.
There is cash locked up with the customer.
So, you will have a liquidity crunch.
You will have a liquidity crunch. So, you will have shortage of cash.
Okay.
So, how well are they managing cash?
Yeah.
Right?
Yeah.
So, that is another question. So, these are all many different things. So, but by and large, many of these are mandatorily, companies are asked to disclose it in their financial statements.
Because investors should know.
If it's listed company, of course, they have to disclose. But even non-listed companies are forced to disclose a fair amount of their financial performance. And so, by looking at the the filings of a company in the stock exchange or in the Ministry of Corporate Affairs in India, you can find out basically a fair amount about what's going on inside the company from their financial statements.
Okay. Yeah, I think it's very interesting because if we get this information and if we can have very simple measures,
right?
Basically certain growth rates. And certain ratios and plot these ratios over time, perhaps we can track a company's performance then.
Yeah.
So, let's look at some of these ratios and
which
see
people track. Okay.
How we can actually track the performance of a firm. So, this is called financial analysis. Financial analysis is basically trying to unlock a company's financial performance. All that you just listed out in terms of, liquidity, in terms of certain efficiency parameter, everything becomes a part of this financial analysis then. Now, in financial analysis, what we are interested is to assess the firm's past, present and future financial conditions. Past we have data, present also we have data. Using the past and present data, we might be able to project in future. Given the market conditions, the firm is likely to perform like this. So, we can actually look at the financial strengths and weaknesses of a firm. And very importantly, you can actually look at certain benchmarks of the industry, certain other firms and compared to firm X, firm Y is doing better or firm Y is doing badly and things of that sort. And we have a lot of data for this. As you just mentioned, there are a lot of financial statements data available, as well as, there are ratios and a lot of industry reports in the public domain which can be used for looking at the financial analysis. So, 4 important categories of data are available. One is the Paka balance sheet. From there we can look at the authentic balance sheet analysis.
So balance sheet, some of our students may not know. So balance sheet is?
Balance sheet is the annual financial performance of a company, put in different heads.
Okay.
And a broad category is in terms of assets and liabilities. I have to get this much and I owe this much.
Assets are basically things which I own.
Right.
Like factory equipment would be asset.
Yeah.
Land would be asset.
And then liabilities. And then you classify this. What are your liabilities?
Liability is loan. I have taken a loan, so I have to repay.
Yes.
That's a liability.
Yes.
Okay.
And then you put it in a very specific format. And that's not an easy job, because you have to classify this, which is a liability and which is
an asset.
An asset. It's a tricky thing.
Tricky thing.
Yeah. But then I think that is an accountant's job, which is accomplished quite well. So balance sheet information provides one source of data. There's a lot of income statements of this company. Income can come from various sources for a company.
Right.
From sales, from non-sales kind of incomes, because for example, a company might have made profit in teeth period, and in T+1, it would have parked this profit in some other investments.
Okay. You have to put it in a bank
or a bond or
something else.
That can also give you income.
Interest, it could give you.
Interest income.
You would earn interest.
So income analysis, income statement is very important, because that also gives us
where all you're getting
where all your sources of income. Then, as we just discussed, cash flow statement is very important. From where this money is coming, from where it is going, and what is the delay. Very, very important in terms of understanding the liquidity position.
Yeah.
And then a lot of companies actually retain their earnings.
Right.
Retained earning means, at the end of the financial year, you have so much with you. That is, after paying your tax, after paying your dividends, after paying your depreciation, after all that, you have so much with you. What are you going to do with that?
Yeah.
One possibility is that you can give more dividends to people.
Yeah. Buy back your shares. That's what they do. Some of them.
Some of them do. The other possibility is that you can actually invest in some other expansion of the firm.
You can build more plant.
More plants.
Yeah.
Or you can buy out another firm.
Or just keep it.
Yeah, or just keep it. And when you keep it,
sometimes, so you don't know.
Yeah, when you keep it, you might keep it some in liquid and some in some kind of assets kind of a thing.
Yeah.
So all these financial statements analysis then give us an idea of the financial health and performance of a firm. Now, the simplest of analysis is using some ratios. And this is very interesting, because these ratios gives us a lot of insights in terms of, how the firm is performing, and we'll show some of these ratios. That's the whole idea. Why are we using at ratios? We are using at ratios because, see, firms will be of different sizes. So you need to have a standardized form, because sales of one firm will be very high and sales of another firm will be very small. So if you standardize everything according to firm's sales, then you have a ratio which is comparable then. So for comparability purpose, we use ratio analysis.
Okay.
Otherwise, it becomes very difficult.
Yeah.
Because actual numbers could be very misleading in terms of comparisons. So that's one important thing which we do in terms of, ratio analysis. And also, it gives us an idea in terms of benchmarking against industry standards. There are certain industry standards, and where are we, or as a firm?
So, by industry standard, you mean that for some industries, the profitability level. So, for example, manufacturing, we said, is cost plus.
Yeah.
So, their profit margin of, say 5 to 10% might be acceptable.
Yeah.
Right.
And within manufacturing,
IT, it will not be acceptable.
It will not be acceptable.
5 to 10% considered to be a very bad margin in IT, right?
Yeah.
That's what you mean by it.
Yes.
Okay.
And within manufacturing, a cement industry's margins might be entirely different from textiles. or FMCG.
Right.
So So we can actually use these statements to have a kind of a benchmarking of firms and industries. So the ratio analysis then is very important in terms of assessing the efficiency of operations of firms then. So there are 5 major ratios that we use. One is the liquidity ratio. Second is the investment, that is from shareholders' point of view. Third is what is known as gearing ratio. That is, it gives us information on the relationship between exposure of business to loans as opposed to share capital. Then of course profitability, that is everyone would like to see what is the profitability. And then a set of financial ratios, that is the rate at which company sells its stocks, and efficiency with which it uses its assets. Very important, because if you pile up a lot of inventories, so if you have certain ratios where you use inventories also, then we know that perhaps the demand for what the firm produces in the market is not very high. If the demand is not very high, then the cash inflow will be less. If the cash inflow is very less, it might affect your gearing as well as your other ratios. So on the whole, we use this 5 set of ratios, that's liquidity, investment ratio, gearing ratio, profitability ratio, and financial ratio. Now, we won't go to an exhaustive list of all these ratios, but we will quickly look at some of the important ratios. One is what is known as the asset test, that is the Q ratio. That is, what is the ratio of your current assets to your current liabilities? We talked about the balance sheet where you have assets and liabilities.
Out of them, some are called current.
Current. At this particular point in time, what is your asset position and what is your liability position? Now, in this current assets, we can actually current asset minus stock, because stock is something that you have accumulated in the past. That is why we use the word current now. Now, if you have a 1:1 ratio, your current asset to current liability is 1:1, that you are fine. But if it is not, then there is a problem. For example, a ratio of 3:1 suggests that firm has 3 times as much as cash it owes. So, it's a very healthy firm.
So, there's a lot of assets.
Lots of assets.
Compared to, current assets, compared to liabilities.
Liabilities.
That's correct.
But a ratio of something like 0.5:1 means, the firm has twice as many liabilities as it has assets.
Which means that it has to double its assets to even pay back the amount of money.
So there is something wrong, and there is some pressure.
In fact, typically liabilities, loans would be, the bank would basically hypothecate, it will basically ensure that the loan is given against some asset only, So it's getting to 0.5:1, but usually it's not so easy to get to that state of 0.5:1, unless you have loans which you have taken without such hypothesis.
There's a problem there in the sense of, banks might have different valuations. So banks might think that,
their assets are valued something.
And this firm might do very well.
They may make some estimation.
And then they sometimes lend
money.
And that is one of the reasons why we accumulate non-performing assets for the banks.
And assets also value will decline over time.
If it is.
At the time when they took the loan, the asset may have valued something. Then it may decline. So all this. So it becomes 0.5:1. And now they have a problem.
Yes.
This company. All right.
So one thing is, this is the asset test. What is known as the Q ratio. Because you can compute it quickly from the balance sheet. Second is the current ratio. That is, current ratio is nothing but current assets to current liabilities. But there is one difference between the Q ratio and the current ratio. In the Q ratio, current assets minus stock. But here we are not deducting that stock. So it's just a kind of a derivative of the earlier kind of a Q ratio. And then again, too high or too low. Too high means too much of its assets are tied up, perhaps in unproductive sectors. And too much of assets have been stocked. You can unleash these assets perhaps. And that information we are getting from this stock. In the earlier it is deducted. So too low means, well, you will not be able to repay your liabilities, so there is a problem. So it's a variant of the asset test. Third thing is investment and shareholders ratios. There are a lot of ratios in this, but we won't go into the details of this. This is very simple computations. But generally what people look at as an investor, this from an investor's perspective, what ratio they will have. That is earnings per share. What is earnings per share? Earnings per share is nothing but profit after tax, PAT, yeah, divided by the number of shares. So the company would have raised capital by floating shares. So there is the total number of shares that the company has floated, and you have the profit after tax.
Just divide one by that.
Just divide by that. You will get roughly what is the earnings per share.
What is the profit per share?
Yeah.
In some sense, yeah.
Now looking at that, I will invest in companies.
Yeah.
As an investor.
Yeah.
So as an investor, as a prudent investor, I will invest in a company which gives me more earnings per share.
Yeah.
So that is why this is a kind of a shareholders ratio. Then there is price earnings ratio, then there is enterprise value by EBITDA ratio, and then there is dividend yield ratio. Now all these ratios, we are not going to the details of each of that, but basically these are to assess how investors would actually look
whether
at
it is giving, the company is giving enough value to investors or not.
Yeah. Now, so that is from an investor's or a shareholder's perspective.
Yeah.
Then there is very, very important gearing ratio. That is long-term loans divided by the capital employed. What does it give us? It gives us an idea as to, given your capital, so loans can be short-term or long-term. Now, given our assets and capital that we have now, will we be able to repay the loans, long-term loans that we have taken? So, higher the ratio, more the business is exposed to the interest rate fluctuations, because long-term interest rates might actually vary. Yeah, and you have to pay back this interest rate and loans before you're thinking of reinvesting somewhere or you're expanding somewhere. Yeah.
So, how much of the capital that you have employed has come from long-term loans?
Yeah,
that's what you're checking.
Yeah. Now this is very, 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 very interesting, because some of these corporate houses, at particular phases of expansion,
they borrow a lot of money.
They borrow quite a bit of money.
They borrow using bonds, long-term bonds.
15 years or 20
15 year, 20-year bonds.
Yeah.
Sometimes these bonds are they take money from overseas.
Yeah.
It's dollar bonds.
Yeah.
So not only is it sensitive to interest rate,
but also
sensitive to dollar to rupee exchange rate.
Exchange rate fluctuations also.
Yeah.
So looking at this gearing ratio, then the firm decides, okay, it is time for us to restructure. We should reduce this debt levels. Yeah, we had a very interesting kind of an example in the Indian context recently. That is the Reliance Industries thing.
Right.
Reliance had a restructuring of their capital and then reduction of their debts.
They reduced the debt. Yeah.
Debts and
they said they'll become debt free.
Yeah. That is because at some point they had borrowed and it was a
huge amount of money.
It was
set up the telecom business.
Yes.
Yeah.
So gearing ratio then gives us an idea in terms of long-term loans.
Right.
Then of course profitability ratios, which every investor as well as the firm is also very keen to know. There you have the gross profit and the net profit. Gross profit is nothing but total revenue or turnover minus the variable cost. Now our concepts of cost becomes very important. Variable cost is only used here, that is cost of sales.
Right.
And in net profit, well, variable and fixed costs, overheads are actually utilized, and that will give us an idea in terms of what is the kind of profits that the company is generating using the assets that the company have. Yeah. Now we will see it in a slightly different perspective, because there is also the gross profit margin, which can easily be computed, because margins also give us an idea as to where the firm stands in the market. A firm which has got higher market share and command over the market can have higher margins.
Higher gross profit margins.
Higher gross profit margins. So this gross profit margin is computed by gross profits divided by turnover.
Turnover means revenue.
Revenues. Yeah. So higher the gross profit margin, better for the company. So it's a very simple kind of a ratio. So a gross profit margin of 45% means that for every rupee or pound or euro sales that I am having, the firm makes 45 percentage of that as gross profit. Yeah, that's a very abnormally high figure that we have put. But generally That's how we interpret this whole.
It's okay actually, because there are semiconductor industry, all these IP intensive industries make margins, gross
huge margins.
Very good. Correct. So
then
semiconductor rate is like 70 and 80%.
Oh, okay. That's a very interesting kind of an industry to examine then. Then there is the net profit margin, which is nothing but the net profit by turnover. Now here net profit takes into account the fixed cost involved in the production, that is the overheads that are involved, and keeping a control over this fixed cost is very important. Because fixed costs also needs maintenance in that. For example, I'll give you a very simple example. That is, a photocopier is switched on whole night. So it consumes power.
It consumes electricity,
So the electricity bill will go up. That electricity bill, if we had actually utilized that power, we could have photocopied so many copies. So you are actually paying for the electricity without using the machine. So we should be very clear in terms of using that overheads. That is why net profit margin gives us useful insights than gross profit margin.
Correct.
Now, the other thing is to see these profits in terms of the capital employed. That is, conceptually these ratios are fine, but you need to relate it to what percentage of capital are we really getting back. So, we use a concept of return on capital employed, ROCE. Now, ROCE, what we are doing is that profit by capital employed. Now, again, higher the better. So, we also see that an ROCE of 25% means that for every 1 rupee or $1 that is getting invested, it generates 25% of that as profit
every year. So it's a good investment.
It's a good firm to invest, and it's a growing industry, and the firm is efficient. It is efficiently utilizing its capital. You can interpret it in a different way. So, in a sense, I would use partially. It is a measure of the efficiency of the organization and the use of capital.
How well they're allocating using
and how they are able to recoup the invested money that is invested in capital. So this is a very, very interesting and a very important kind of a measure. Then there are certain turnover ratios that we use. That is asset turnover. That is nothing but sales turnover by assets employed. Now,
how much revenue you are producing for every machine that you are putting in?
How you are actually using your assets to generate profits.
Revenues.
The assumption is that when you are generating revenues, you are generating profits. So this is a very important kind of a asset utilization ratio. And related to that is the stock turnover ratio. That is, we talked about this when you have lot of goods that are getting produced, and then if they are getting piled up, then there is a problem. So stock turnover ratio is nothing but cost of goods sold by the stock expressed in as times per year. So you are stocking 3 times per year or 4 times per year, but your sales is actually less, which means that the market condition is not, or you are not able to penetrate to the market more. So the rate at which companies have their kind of stocks,
inventory is being, how many times the inventory is rotated
in terms of one.
So which means that you put something in the warehouse, it got cleared out. You put something else again it got cleared out. Like that. So how many times are you?
So that's another kind of a demand.
Correct.
Finally, related to that is what is known as debtor days. This is very important, and we talked about that in the beginning, because that is debtors by the sales turnover, which means that it gives a measure how long it takes for the business to recover its debts.
Collect your money from the customers.
And we talked about government contracts and all at the beginning. So if you are putting too much in certain businesses where there is a delay in terms of recouping the money, then definitely there is a kind of a liquidity problem that you might face. So debtor days is very, very.
So it's represented in terms of days.
So
you're expected to collect your money in say 60 days, but you might actually have 90 days, which means you're 30 days overdue.
Yeah.
It might take 120 days to get your money back, which
Yeah.
means that the industry norm is 60 days.
Yes.
You're getting your money back in 120 days.
Yeah.
Which means that you have 60 days worth of sales which
Yeah.
you have not collected.
Yes.
So it affects your cash position.
Yes,
like
yes.
Yeah.
It's very important because you have to pay your variable costs.
You have to pay your employees. You have to keep
Yeah.
paying. Yeah.
So we see that there will be a working capital problem
Requirement.
in this kind of a firm.
Situation.
So you'll have to borrow to finance your
Finance
working
your-
capital. If you borrow and finance your working capital, you have to pay
Interest
interest
also.
on that.
So your profitability will get affected.
Will get affected. So
Right.
that's why this is a very important ratio. So this is basically a broad overview of the financial ratios. But then we also need to understand why we are using it, in what context we are using it,
Right.
because it gives us an idea in terms of benchmarking the company
Yeah.
with the past performance of the company as well as in terms of the industry.
Right.
And also, very
And
importantly,
it's industry neutral in the sense that I can see, for example, return on capital employed.
Yeah.
I don't care what the company is,
Yeah.
which industry sector it is, because
Yeah.
if I'm putting 100 rupees of my money
Yeah.
as an investment in somebody's company,
Yeah.
I could have put it in somebody else's company.
yes,
So I can just use ROCE to compare these two. One can be a steel company, one can be IT company,
Yeah.
one can be a bank. It
Yeah.
doesn't matter. Right?
yeah,
So this way it becomes neutral to the industry. Of course, when you compare profitability or something, you will look at companies within one industry.
industry.
Yeah.
And also, exactly like what you pointed out, as an investor, we might look at earnings per share.
Earnings per share. Yeah. How does it matter what industry it is?
What industry,
Whoever
whichever
gives me better earnings per share, I'll put it there.
as an investor, I might put my money
Yeah.
there.
Yeah.
So that's why it's very interesting, because it also adjusts for the size differences. Of
Size
our
differences
companies.
also.
Some of the small firms could actually give you higher earnings per share.
Yeah.
So all that is taken care of with this simple ratio analysis. But then there are certain limitations. The limitations are in terms of, this accounting practices might differ according firms and industries very marginally, but there is now a global standards as well as country specific standards. But still there could be the classification and the valuation problems that would come there. But more or less there is a set standard. But the important thing is that there are seasonality effects that we talked about in the beginning. There could be certain times of the year you have. So this is very important, because if you are doing quarterly analysis ratios, in one quarter what happened and compare it with the other quarter, this seasonality has to be. So then you have to look at quarterly along with the annual. Annual over years will take care of the seasonal. Every year you will have this seasonal.
You will have a lean season.
Yeah.
So if you're a company that is selling holidays, for example, obviously during the holiday period you will have sales.
Yeah.
Other period you're not expected to have sales.
Exactly.
So comparing the holiday period with the non-holiday period,
it does not make much. So that is why this quarterly analysis or monthly or whatever financial ratios which we compute should also be looked in a slightly long-term perspective to take care of the seasonality issues.
Right. Yeah.
I think GV will stop here.